All right, today we are throwing the modern stock market under an absolute microscope. We're going to dig into the true underlying valuations of the market's biggest players. But listen, we are completely ignoring momentum today, and we're definitely ignoring the hype. Instead, we are running these giants through a highly disciplined, Warren Buffett-style value investing lens. We want to know, do these businesses have real, durable competitive advantages? Is their debt actually sensible? And most importantly, are they trading at a legitimate discount to their intrinsic value? Let's find out.
So, in today's explainer, here's our roadmap. We'll kick things off by looking at the top-heavy index risk, run through the Buffett valuation framework, and then sort these megacaps into three buckets: price for perfection, wonderful and fair, and finally, those rare megacaps with a true margin of safety. Then we'll wrap it all up with a final verdict for the passive investor.
Starting right off with Section 1, the top-heavy index risk.
Okay, look at this number, 46.2%. That is wild. Nearly half of the entire Vanguard S&P 500 ETF, which we all know as VOO, is concentrated in just 21 mega-cap companies. You know, if you're a passive index investor, you probably assume you own this highly diversified, broad slice of the American economy. But reality check? Almost half of your hard-earned capital is heavily exposed to the performance and the valuations of just these 21 specific stocks. If these giants happen to be overvalued, your passive portfolio is carrying a massive amount of hidden risk.
Moving right along to Section 2, the Buffett valuation framework.
So what is our guiding star here? It's the classic margin of safety. As a strict value investor, you only want to buy a wonderful business when it trades at a significant discount to its actual intrinsic value. We're demanding durable competitive advantages, those beautiful moats, plus high, consistent returns on equity, and owner-oriented management. And we are completely avoiding businesses where future cash flows are just a guessing game. We want current owner earnings that actually justify the price tag today.
Now, to measure this impartially and strip out all the market emotion, our source analysis uses four very specific data-driven metrics. First up is discounted cash flow, or DCF, which compares projected free cash flows against the current market price. Second, we look at the trailing price to earnings compared to the stock's own 5-year historical average. Third is the PEG ratio, which smartly adjusts that PE for expected growth. And fourth, the proprietary guru-focused GF value model. By passing these megacaps through all four of these lenses, we can cut through the noise and find the truth.
Which brings us to Section 3, the companies that are, well, priced for perfection. Let's look at Tesla, because honestly, it perfectly illustrates the danger here. It is currently trading at a jaw-dropping trailing PE of 371 times earnings. Just to put that into perspective, the standard auto industry average sits around 15 times. And get this, Tesla's earnings have actually contracted recently. Its sky-high valuation relies incredibly heavily on unproven future technologies, like Optimus and robotaxis. This totally violates the core Buffett principle of demanding current predictable owner earnings. When a stock is priced at 371 times earnings, based on a highly uncertain future, there is absolutely zero margin of safety. But hey, it's not just the flashy tech names. Take a look at our quintessential American retailers, Costco and Walmart, are undeniably wonderful businesses. I mean, Charlie Munger himself served on Costco's board. But we have to remember, even the absolute best business can be a terrible investment if you buy it at the wrong price. Costco is trading at 54 times earnings with just 6 to 8% revenue growth. Walmart is at 48 times earnings with 4.7% revenue growth. Both are sitting at PEG ratios around 5.0, which frankly screams overvaluation. At these historic highs, the market is pricing in utter perfection.
And then there's Broadcom, trading around $421. What's honestly kind of terrifying here is the extreme divergence in the DCF models. Intrinsic value estimates range wildly, from $68 all the way to $263. But notice that every single one of those estimates is massively below the current price. Plus, they carry significant debt from their VMware acquisition. Buffett always teaches us to avoid businesses we can't confidently value. When future cash flows are this uncertain and the debt is this high, that is a glaring red flag for any conservative investor.
Let's shift gears a bit to Section 4, the wonderful and fair bucket.
Check out this back-to-back comparison between Visa and MasterCard. We're talking about incredibly asset-light toll booth business models with enormous, durable network effect moats. Visa boasts a 45% return on equity, and MasterCard, they're sitting at a staggering 120% ROE. Yet look at the valuations. Visa is at a 27.9 PE, which is actually below its 10-year average. MasterCard is at 28.4, below its 5-year average. Now, sure, these aren't deep discount bottom-of-the-barrel bargains, but they are spectacular compounders trading at totally reasonable historical multiples.
A few other household names gracefully land in this fairly valued bucket too. Ironically enough, Buffett's own Berkshire Hathaway screens is reasonably priced, sporting a PE of 13.9 and a frankly massive cash hoard. Chevron presents this pristine balance sheet with a solid 3.7% yield, which serves as a great hedge on energy prices. And yeah, even Amazon makes the list. While its reported earnings might look a bit expensive because of massive capital expenditures, if you actually look at their normalized owner earnings, the stock appears super reasonably valued for its quality.
All right, now for the really exciting part. Section 5, Megacaps with a Margin.
This right here is a value investor's dream scenario. Look at this. Microsoft has a wide-moat enterprise software business, totally predictable owner earnings, and its PE is sitting near a 10-year low. JP Morgan Chase, widely considered America's best-run bank, offers a fortress balance sheet at just 14.4 times earnings. Screening is roughly 29% undervalued by excess return models. And AbbVie, even though its GAAP earnings look a bit distorted, trades at a forward PE of just 14.1 with a massive discount to its intrinsic value. This proves, without a doubt, that durable mega-cap moats can still be bought with significant upside.
But we really have to talk about Meta. This one is a super rare mega-cap consensus across almost every single valuation lens we have. DCF models consistently point to significant undervaluation here. At a 22 trailing PE with double-digit revenue growth, massive free cash flow generation, and a PEG ratio sitting right around 1.0, Meta is a pure value screen success. It offers a legitimate, undeniable margin of safety for investors who are actually willing to look at the math rather than just the market sentiment.
Finally, bringing it all home with Section 6, the passive investor's verdict.
So pull all of this together, and what do we get? Out of those 21 megacaps that absolutely dominate the S&P 500, they split into these incredibly clean thirds. 7 are severely overvalued and priced for perfection. 7 are wonderful businesses trading at a fair price. And 7 are actually undervalued, offering a true margin of safety. Visually, it looks completely balanced, right? But here is where the mechanical structure of the index completely changes the reality for your money.
Because the S&P 500 is market cap weighted, the biggest companies take up the most space. And unfortunately for passive investors, the most wildly overvalued stocks, we're talking Apple, Tesla, Broadcom, command a massive chunk of the index. Because of this weighting, over 20% of the entire Vanguard S&P 500 ETF is heavily tied up in that significantly overvalued slice. You are disproportionately exposed to stocks trading way above their fundamental intrinsic value.
The bottom line takeaway from our source material sums this up perfectly. Passive index exposure embeds significant overvaluation risk. The antidote is holding cash and waiting patiently for individual opportunities. And you know, this is exactly why disciplined investors like Berkshire Hathaway are currently holding hundreds of billions in cash. They flat out refuse to systematically buy into overvalued assets just for the sake of being in the market. They are waiting for that pitch right in their strike zone.
So I want to leave you with this one final thought to chew on. We've seen the data, we've applied the strict margin of safety test. With a full fifth of the S&P 500 currently trading at multiples that demand absolute perfection and offering zero margin for error, is your passive portfolio truly safe? Or is it finally time to start looking at the underlying intrinsic value of what you actually own? Thanks for joining me for this explainer, and keep learning.